So there's two trends the price can follow, and we're not talking about an uptrend or a downtrend, but about the external trend and internal trend. On the external trend, we only care about the external swing points. They're basically the lowest and highest points a market had during a certain time. For example, if we analyze those points on this market, we have a swing low from where we started that goes into marking a swing high, which was highest point we've had at this moment. And from this extreme high, the price is falling down to find a swing low. Now the question is, will this swing low break the last low, forming an external lower low, getting this market into an external downtrend? Or will this swing low end above the last low, forming a higher low, getting this market into an uptrend? Well, if we look on the left of the last price level, basically right at the beginning of this price action, there is a demand, which is the last downside candle before the market started this upside action, and this is an external demand taken from the high time frame. And the price is currently right at this moment sitting on this high time frame demand. So on the external trend, there is a good chance we see a bounce from this demand, so this would favor a buy setup. But what about the internal trend? Let's look at it. The internal trend is basically the price action that's inside of the external trend. So for example, this straight upside movement internally is seen with a price action that's creating higher highs and higher lows, holding an uptrend pattern internally. But then this internal uptrend ends with a low breaking the last low, this creating the first lower low formation. However, keep in mind that this is happening on the internal trend. The fact that we now have the first internal lower low, that indicates a trend shift on the internal trend, from a previous internal uptrend into a highly likely upcoming internal downtrend. And on a downtrend, as we know, the price has upside pullbacks that can't break above the last high, so it must end below the last high, but below the last internal high, which is this one. Not necessarily below the external high, which is this one. Now, of course, logically, if it ends below this one from below, that also means that it ended below the swing high from the external level. But the reason we care about the high ending specifically below the last internal high is that that's where we need to identify a supply or resistance level, basically from the previous internal high, and that level is the last upside candle before the market started pushing down. And that is exactly this candle. This is an internal supply or internal resistance level. If you watch my channel for a while, you know about them, and I keep emphasizing on their theory because they respect well. Here it also did, since we see that the next pullback to the upside ended exactly on the supply taken from the previous high. But make sure to not confuse the external trend with the internal trend, because that's the only thing that should be more complex or hard to understand, but the theory of the supply is straightforward and simple. From supply levels, we just look for sell setups with the stop loss above the supply and take profit below the last internal low, because the supply is a rejection structure that pushes the price down into breaking the last low, which is exactly what it did right here. The downside push breaking below the last low. But pay attention because we are talking about the last internal low and not about the last external low. Make sure to not confuse them. And now what we have from this low is that the price pulled back up and actually broke above the last internal high. So this again would be an internal trend shift from the previous trend, which was a downtrend, into a possible uptrend. On uptrends, after the price breaks the last high, we need to look for demand or support levels that are taken from the last low. And more specifically, the internal demand is the last down candle before the price started pushing up, which is around this candle, this being an internal demand. But the thing is that we see that this demand did not respect it since the price basically just pushed down and broke below the demand. So a buy setup from this demand would have ended as a losing setup. There's two reasons why this happened. The first one is the most obvious and simple one, which is that we can't expect every level to respect, because trading would be way too easy and that's not realistic. But you don't need to win every setup. And actually, if you hold a decently high risk-reward ratio, you can lose a lot more setups than you actually win, and still end up in net positive. However, keep in mind that every action happens for a reason and was caused by something. In this case, for example, the price broke below the internal demand, but this break caused the high time frame demand to get filled right here. So even if we were wrong about a trend or structure, that itself creates new opportunities where we need to pay attention to find them, and you can ask, what if this demand also breaks down? Well, a high time frame demand will usually still get a bounce to the upside on the internal trend. So even if this demand would break down, we can still look for an opportunity inside of the internal trend of an external demand. So these trends can play together in what we call it as being a time frame confluence. The way we can do that is to switch into a low time frame the moment the price hits the high time frame demand. For example, this is the 15 minutes time frame, and we see the exact moment the price has hit into the high time frame demand. The way it has hit into the demand is by initially forming this internal downtrending price action, slowly pulling the price into the demand. Now we could just buy this high time frame demand, but that means that we're buying an external high time frame demand on a low time frame, with the targets based on the high time frame demand. So it doesn't really make any difference on why we would buy this demand from this time frame rather than from the 4-hour time frame where we've been before, since the demand basically has the same stop loss target, which should be below the demand, and take profit above the last high. But the reason we've switched into this time frame is to identify the moment the internal trend shifts into an uptrend from the high time frame demand. For example, we can look at what just happened. It essentially went down for a few more candles, and then it bounced to the upside, leaving the external demand, and this bounce managing to break above the previous internal high. So it has created the very first internal higher high from this time frame. The first break above the internal high is an internal trend shift from a previous trend, which was a downtrend. We see that from the swing points the market has been forming, which they are lower highs and lower lows, basically swing points of a downtrend. So the trend shift reverses the previous internal downtrend into a potential upcoming internal uptrend. And now, instead of trading the external demand, we actually look for an internal demand that's inside of the external demand, which is this candle right here. That's an internal demand or internal support level. And it's from this internal demand where we can now plan a setup, a buy position in this case, with the stop loss below the internal demand and not below the external demand. The take profit is placed above one of the previous internal highs, for example from around this high. We need to see what ratio we can get out of this target. And if it's lower than 1 to 2, we look for a higher target. So looking for the high previous to that one. And that's around this level. This target's a 1 to 4, which is quite high, but given the fact that the analysis was so complex, we can afford this risk. Price hits into the internal demand on the next candle, opening the buy position. Here it dropped lower on the demand, almost breaking it into the stop loss, but the next candle completely covers up the previous bearish candle. So this is a huge sign the momentum is likely to shift into some bullish action, which is what it eventually did. Now we only need this upside pressure to keep holding. And now the price finally breaks up into closing the setup on the take profit. And let's see why this works so well. If we look at this price action, this looks super bullish. It's like the market literally can't stop going up. But if we switch back on the high time frame, we see how that super bullish momentum is really just this small movement. So what we did is to take advantage of the price bouncing up from an external demand. But the setup itself was planned from an internal demand. That's the trick of time frame confluence. And it won't even matter if the external trend from here turns into a downtrend, or if the external trend turns into an uptrend, since we're already out with a winning setup from the internal trend before any new uptrend or downtrend should begin on the external trend. I go in deep details on the program linked in the description if you want to take a look at it, where I have a bunch of materials helping you properly understand the price action, so you can start winning, but also most importantly, not losing the wins back.